Hello, everybody. It's Dr. Rick dropping in on you. Hope everybody is having a great week to this point. I hope that everything that you're aspiring to do, that you have set your pace and your focus and your direction and your energy towards it. Remember that this is a journey, it's a process. Anything that you are attempting to do of any true intrinsic and tangible value, it's going to require energy, effort, focus, commitment, and resilience. Anything worth having comes with challenge. So don't you quit, don't you give up. Look, it's Wednesday, another Wednesday, Wealth Building Wednesday. We're going to get right into it. This segment of Wealth Building Wednesday is brought to you by the Legacy Wealth Academy and our flagship program, The Path to Generational Wealth. Real briefly, check out the information in the description box. And I want to tell you a little bit more about it, but we are offering an unbelievable opportunity for you to sign up for this 18-month course. It is the most comprehensive online course solely focused on wealth building out there. Trust me, and it took me a long time to build it, but it's there for you now. Look, on top of that, those who sign up today will also get a free bronze package with me. That's 12 weeks, 12 sessions, intensive. So just keep that in mind. Look, if you like what you see and hear in these videos, click the like button, click the share button. If there are things you want to know, even if you don't get it on the live version, come in, type your questions, because I will or someone else will be reviewing them so that we can cover the topics of concern. We want to be a place that is resourceful. We want to be a resource to you. So again, I encourage you, hit the like button, hit the share button, subscribe and follow, and leave comments. Tell me what you like. Tell me what you didn't like. Tell me what you would like me to talk about. This is about growth. This is about development, and it's interaction. That's exchange. You exchange, even if it's me giving and you telling me what you need, whatever it is, it's got to be an exchange. So it's no way I can cover everything in one sitting. That's not what this is about. This is about giving you things that you can take and say, wow, I never thought of that, or take and say, that's where I need to start. Man, that's what's happening with me. Whatever it is, whether it's about success, whether it's about healing and trauma, whether it's about finance, whether it's about relationships, whether it's about business, it's coming from an area of extensive experience over 35 years for me, in a vein where I have really hung my hat and been very successful. And I want to share what I know with people on a regular basis. And hopefully some of you will feel the need and the desire to say, man, I want to get closer to this guy. I want to work with this guy. I believe he can really help me, and I would love for that to happen. But here we go. Here's the thing. Today is Wealth Building Wisdom. What we're going to talk about, it's going to be a real simple principle, but it's very important for anyone who's talking about investing, for anyone who's talking about getting into the game. Now, it primarily applies to stock, but it is literally, to me, it can be translated into any type of investment you want, and that is creating a margin of safety. So what is a margin of safety in investing? We're going to talk about it in the vein of stock, but it applies, like I said, to anything that you're going to invest in. It's a principle, it's a philosophy, it's an approach. But when you're talking about stock, a margin of safety is going to be, first of all, determined by the investor. And basically what it is the difference between the prevailing value of the stock and the perceived intrinsic value of the stock. So the prevailing value of the stock is the best price that the buyer can get the stock at. That means this is the price I'm buying it at. And based on my homework, based on my research, based on what I believe about this stock, it's actually worth this. So for instance, you see a stock and your intrinsic value, your assessment on the intrinsic value of the stock is that it's worth $100 a share, but it's selling for $80 per share, then your margin of safety is 20%. So to me, when I'm talking about margins of safety, I start at 20%, depending on your your level of risk aversion, your level of what you are comfortable with losing. And here's the very important thing, I can't stress this enough. Don't invest what you cannot stand to lose. Now, and here's why. Nobody can predict the market. Nobody can predict downshifts in economies. You can look at it and you can pretty much have an educated guess, but nobody can guarantee, hey, this is what's going to happen tomorrow, because there are so many different variables. Warren Buffett has said he can't do it. Ray Dalio said he can't do it. David Swenson has said he can't do it. Jack Vogel has said he can't do it. I mean, and I can go on down the line of people who make their money literally investing in other companies by way of the stock market, and you're going to find out that none of the heavy players, matter of fact, they sit up and they'll tell you the people who try to play their game lose 96% of the time. Actively managed mutual funds lose 96% of the time, and the 4% that win aren't the same 4%. So nobody's killing the game in guessing the stock market. So that's not the game you want to play. What you want to do is you want to play the educated long game, but you have to understand that's always a downside. The downside is is your risk. What you want to do is you want to hedge against the downside, reduce the potential impact of the downside movement. So in essence, if I come in and I am able to get a stock at $80, but the stock is already worth $100, and you can translate that into real estate, you can translate that into energy and any other thing you want to get into. So if I come in and I buy it and it's already worth more than I paid for it, number one is I've already increased my value, I've already increased my net worth, and I am hedged against it moving in the downside. Why? Because if I get a 20% margin, and that's where I would start. Some people won't get in, and if it's not at least 40% higher than the prevailing value. And so and it's all about your comfort level. Again, you got to know how comfortable I am with this, and each person is different. And another thing, go to a site and they're out there. Just type in investment type or risk. A risk analysis or investment type to determine what your level of risk aversion is. Are you an aggressive person by nature? Are you conservative? Are you midstream, progressive, whatever? You need to really find out, and it can really let you know. It's gotten a lot more detailed than it used to be. So you can now determine and understand how you move so that you can be aware of what's driving you naturally. Sometimes you got to get out of your head, out of your mind, out of your natural emotional bends to make solid decisions. So you need to know what you'll naturally do and say, is this, am I making this decision because that's just how I am, or am I making this decision because it's a good decision? What does the numbers say? And sometimes you follow your gut instinct, but this is why you diversify. This is why you hedge. This is why you create all of these safety mechanisms so that when you do go out there and you make a gut move and it's not the right one, it doesn't take you down, it doesn't destroy you. Or you go out there and you make a solid move based on all the numbers and it doesn't play out. All these things are possible when you're talking about investing. There is no guarantee. There's no, okay, this is the way to go and it's going to automatically produce. You can definitely increase your chances of success by taking some well-known principles and applying them. I'm about the long game. You got to hedge with something that's long, highly conservative, and very consistently producing over time, regardless of the turbulence. That when you look at it over 20 years, this is what it's giving you consistently. And you get into that, you stay into that. That's going to be the thing that you stay with. And then you're going to diversify and build around that based on your tolerance for risk. And so what you have to do is, and here's again, the beautiful thing that I like about setting up a safety margin now is that there's so many tools out there, and here comes AI, and AI can be very, very powerful in this, in helping you analyze data about a company. It can literally, with the right prompts and using the right platform, it can give you an analysis of what this company is capable of, what the value of the stock should be, and ultimately give you an intrinsic value, not just the prevailing value, but the intrinsic value. The intrinsic value is what it's really probably worth, and the actual prevailing value is the best price you're going to get it at, and that is a number of other different factors. You also always have to include and understand the cost for every transaction. There are commission fees, there are transaction fees. Then you need to understand tax liabilities, but that only comes in on the gains. So, and then there are ways of protecting that. You need to learn about trusts and all these different ways to protect against excessive taxes and dual taxation. An unincorporated business trust is one way. Another trust is a living trust. There are a bunch of different ways. The unincorporated business trust allows you to move, invest, buy, purchase, and protect and hedge against personal liabilities, but also it's to me the equivalent of a corporation with one less tax lever. So it's to me it's better if you know how to have it set up legally, because the IRS actually literally hates it. But it's legitimate and you can set it up. You just need to make sure it's set up correctly, and that's why you get someone who's a trust expert to set that up for you. But back into the vein of this whole thing. So, in essence, you got the prevailing value. You're going to know what that is because that's what they're going to be selling it for. Then you need to figure out the intrinsic value. So, you need to either have learned how to read financials, to do research on historical performance, and all of these different things that are going to help you determine where this is. And you need to know how this company is performing in the market that it's in, because that gives you also insight into the value. So you can start to look, and the beautiful thing again is AI will really help you with that. And I suggest this especially for new investors to get in there. Again, the only thing I will ever tell a new investor to do is get into an index fund, something that produces compound growth over time. I'm favorable to the S&P 500. But over time, it's just going to produce and it's going to compound your growth on what you're putting in, compound the interest that it's giving you. So it'll pay you interest on what you're putting in, then compound on top of the interest it's paying you. It's a beautiful thing when you sit up and use it long term. It's not a get rich quick scheme, it is a builder. And the earlier you start in your life, the better it works for you. It's definitely something everybody should be getting, their teens and they're young adults. So obviously you got to be at least 18 to open an account, but you can open an account in a trust on behalf of your children, have that trust set up to turn over them at any particular given age, and you can start building this from the day that they're born. It's an unbelievable way to prepare for their education, whether they're going to college, whether they're going to study abroad, whatever they can dream up. You start building for that earlier. A lot of things we never learned growing up, and a lot of things we weren't aware of growing up. The information's out there. That's why I created this course, is because we need to know the levers that are out there that they know about, that we don't know about, that they're using, and we're frustrated because we feel we're locked out. We have to unlock the door with our minds. We have to unlock the door with our thirst for knowledge, because the knowledge can no longer be withheld from us if we're willing to seek it. This is why I took 10 years to interview people, to research, to read the books, because I wanted this course to be bigger than my experience in money, bigger than my experience in finance, bigger than my experience in investing. I wanted to take the people who had literally knocked the ball out the park, killed the game, and looked at what they were doing and find the consistencies in what they were doing that were available to the average person. See, the idea is I've got to have XYZ before I can even do this. No, you can find places online, and I shared this a couple of weeks ago. There are places where you can invest with at least as little as $1. And I think most of them you can do it with as little as 5 or 10. So you can make your first purchase, $10 purchase, and you're in the game. And then you can watch how that works and see the movement. And my thing is, prepare to pay the long game. Prepare to make some sacrifices for several years. Prepare to put in and watch how it moves so you learn. Don't panic when the stock prices drop. This is going to happen. Historically, over the last 100 years, it happens every 4 or 5 years. It's been a little crazy and going longer on each side the last 10 or 15, but it's still cyclical. It's still a process that goes, it's going up, it's going down. Market is just literally going to correct itself. So when it becomes inflated because valuations on stocks and other assets and entities are being inflated for whatever reason, eventually the market realizes that they're really not worth that, like housing market. I mean, all these different places have these bubbles that are created through inflated prices for whatever reason, and there are a bunch of variables that go into it. But eventually the market realizes it and corrects itself. And depending on how big the bubble is, when it pops, it can create a significant drop, and we could call that a crisis. And it can go even deeper and be massive, and we'll call that a crash. But market always recovers. We recovered from the depression. We recovered from 2007, which was pretty significant. And so it recovers. And what you want to do is hold, because you don't realize a loss until you sell. You can have a stock and it was worth 100, it drops down to 50. You haven't lost $50 unless you sell it. It's still your stock and it still has the potential to go back up. If you've done your homework, you got to have the confidence that the homework you've done, that the research you've done is what, is real, and that this company will come through. And there are companies that'll show you, man, we've been through 15 of these and this is where we're at. There are just companies you can look at and say, man, that company's going to be around. And you hold it. And then here's another thing that you got to realize. Everything isn't an appreciation investment. And I don't talk about this a lot, but I'm going to share this with you. Everything isn't an appreciation of area. Sometimes you're in a protective investment. What does that mean? Sometimes you're going to invest in something that may lose its value, but you got to ask yourself, will it lose its value as rapidly as cash? Cash is devaluing, especially the US dollar, is devaluing at an unbelievable rate. And so inflation is killing that. So is the depreciation of what you're investing in, does the potential depreciation of what you're investing in over time outperform inflation? That's what you're looking for. So it may not be what it was worth when you invested in it, and it may not be growing, but is it protecting your money? And that's another thing. So what I'm saying is, if I leave it in the bank for 30 years and $1,000 is now worth 650, or I put it into a stock and 30 years from now it's worth 850, which was the better move? I'm hedging loss too. I'm what? Managing my downside. There's going to be downsides. You've got to learn to manage your downsides. You've got to learn to do it. Another thing, and this is just on the side note, find something that you can build that performs on its own. Investment. One of the best investments you can make is in yourself by investing in a business. A lot of people that you see when you look at their net worth, a great deal of their net worth is in the value of the business they own. And so that is that. So I just really want you to really get this. So the idea is to find what the prevailing value or the prevailing price is. That's what you're going to pay for it. And then determine, is it at least 20%, is the intrinsic value of the stock at least 20% greater than the prevailing value? And that gives you a head start. It gives you an advancement. The moment I buy this stock, I actually advance 20%. I increase my net worth by 20% of what, not my net worth by 20%, but I take a 20% hedge on this. And it's, so my net worth is already higher than what I had. So I took $80. And now that $80 is worth $100 right off the bat. And depending on how many of those $80 you have to buy it, you can advance it by that much. So again, it's simple mathematics. You have to learn how to look at it, but you also have to be careful to not get taken in by trends, by rapid market shifts that look great, but you can't explain. Now, it's great for day traders who are hyperactive traders who are literally sitting there the whole time they're in a trade, watching the movement and determining when they want to get out. And even then, they get popped. It's the fastest way to get rich, but the fastest way to go broke by far. If you got the money to play in there, you get people who do it. Literally, that's what they do. They sit down in front of their computers all day and they're in and out of trades. And this is how they make their money. They're day traders. It's not a good practice if you're trying to build solid investments and assets to hold over the long term. It's also not a great mindset of playing like that. To me, it's the equivalent of being a little bit more educated in gambling in Las Vegas. I just watch the people. None of the people who are doing this are the people that you're looking at and you're seeing the excessive wealth being built, because it doesn't play out over the long haul. You get it, you lose it. You get it, you lose it. And you just learn to adjust to it. You know, when I got it, I got it. When I don't, I got to figure out how to get it again. And this is what goes on with that. I want you to be in a good place. So, again, as I get ready to close, today, we're offering the Path to Generational Wealth course. This is an 18-month comprehensive course. This is not get in and in a couple hours you're done, or a week you're done. This is literally setting the foundation. Every element and component of wealth building, from investing to trust, to mentality, real estate, all of the different variables of planning and hedging and diversity. I mean, it's just course after course. Then there are courses within the course. 7 Steps to Financial Freedom is a little 7-week course inside the course. So all these different things are in there. And I spent 10 years doing the research to build it. And normally it's $26.95, $2,695. For a limited time, for the next couple of days, it's going to be $997. But if you get it today and today only, you get to sit down and work with me for 12 weeks while you're going through this course. And we're going to not just talk about finance. We're going to talk about personal development. We're going to talk about where you're going with your career, where you're going with your life. Do you want to start a business? Do you want to, what impact you want to make in the world? Where do you want to advance at? And how do you want to do it? What's going to be the legacy you leave behind? And we're going to work on that. We're going to shift that. We're going to create a rapid change in trajectory in your life. And that comes with us a $3,500 value. But today, if you sign up for the Path to Generational Wealth course, you get it absolutely free. On that note, I got to get out of here. I have a client I need to get with. Speaking of clients, I have a client I need to get with, but I would love to work with you. But I would more importantly love for you to get into this course. If you can master 20% of this course, your life will change forever. Again, this isn't a magical potion. This isn't a get rich quick scheme. This is how you build it. And if you want it to last, you need to build it. And I want to help you do that. So again, as I always say, I live my life on full so that when I leave this place, I die on E. I'm giving myself to this world and I am being blessed so much for it. And I want you to be able to take what you're getting and turn your life around. Build, 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 build. On that note, look, I'm getting ready to get out of here. You guys have an unbelievable remainder of your day. Take care of yourselves, and I'll see you soon. Don't forget, go to that description box, click that link. Also, click the like button, the share button, and subscribe. I'm out.